In today's episode of Face of Money, we're looking at a financial earthquake that might already be affecting you, even if you've never invested a dollar in Japan. After decades of keeping money almost free, Japan has finally raised interest rates, and that single move is now shaking your mortgage costs, your savings account, your 401k, the price of gold, and even the future of crypto. It sounds far away, but the effects are showing up right here, in everyday American life. So today, we're breaking down what really happened, why Japan matters more than people realize, and how this shift could change the way all of us save, spend, and invest. But here's the part most people miss. This isn't just Japan's problem. Imagine waking up one morning and seeing markets more volatile than they've been in years. Stocks wobble, Bitcoin swings, gold jumps and plunges. Bonds yield more than they have in decades. And the headline behind much of this global market turmoil isn't coming from Wall Street or Washington. It's coming from Tokyo.
And all of this is connected to one decision most people aren't watching.
A change in Japan's interest rate policy is now rippling across global markets, and understanding how and why this is happening requires tracing a long story of monetary policy, global capital flows, and financial interdependence.
To understand why this matters so much, we need to go back, way back.
A long era of cheap money. For more than 2 decades, Japan maintained some of the lowest interest rates in the world. Following decades of economic stagnation and deflationary pressures, the Bank of Japan, BOJ, kept rates near zero or even negative to stimulate growth. This ultra-loose policy turned Japan into a source of free money for global investors. The mechanism that made this possible is known as the yen carry trade. Investors would borrow in Japanese yen at rock-bottom rates, convert that yen into higher-yielding currencies like US dollars, and invest in assets offering better returns, from US Treasury bonds to emerging market equities, and most recently even Bitcoin. This is where the hidden risk quietly built up across global markets. This strategy provided vast amounts of liquidity to global markets. Cheap borrowed money helped lift asset prices and kept interest rates around the world lower than they otherwise would have been. Why Japan changed course? So why is Japan raising rates now? After decades of ultra-loose policy, several key forces converged. 1. Inflation began to stick. Japan historically struggled with deflation, but more recently, inflation has pushed above the BOJ's 2% target, driven by higher import costs and wage pressures. 2. The yen weakened significantly. A weaker yen increases the cost of imported goods and services, putting inflationary pressure on everyday households. In recent months, the yen strengthened modestly as markets priced in the possibility of rate hikes, but its overall value and volatility reflect deep adjustments in expectations about BOJ policy. 3. Bond yields are rising. Japanese government bond yields, long suppressed by BOJ's yield curve control, have climbed sharply, hitting levels not seen in years and signaling a departure from decades of ultra-easy monetary policy. A Reuters poll of economists found that most expect the BOJ to raise its policy rate from 0.50% to 0.75% at a December policy meeting, the highest level in decades and a clear shift in strategy. This is where the global chain reaction really begins. How a Japanese policy shift becomes a global shockwave. So how does a rate hike in Japan touch markets around the world? The key link is the carry trade and the broader flows of global capital. For decades, low Japanese rates made borrowed yen extremely cheap. Investors used that cheap capital to chase returns in riskier assets globally. When Japan raises rates, 1. Borrowing costs increase. The cheap funding that powered carry trades becomes more expensive or even unprofitable. This pressures traders to unwind positions. 2. Asset liquidation pressures build. As carry trade positions are unwound, traders sell assets in distant markets, whether equities, bonds, or crypto, to repay yen-denominated borrowings. This creates downward pressure on prices. 3. Capital returns home. Rising yields in Japan can pull capital back into Japanese bonds, decreasing foreign demand for assets like US Treasuries. This chain reaction is why a single change in Japan's policy reverberates across global finance.
Impact on bonds and borrowing costs.
And this is where everyday people start to feel it directly. One of the first major areas affected is the bond market. Japan has long been one of the largest holders of foreign bonds, including U.S. Treasuries. When Japanese rates rise, Japanese investors may find domestic bonds more attractive and shift money home, reducing demand for U.S. bonds. At the same time, higher global yields and tightening liquidity increase borrowing costs broadly. This can lead to higher mortgage rates, costlier student and auto loans, and more expensive corporate borrowing, all of which touch ordinary people's finances directly. This is one reason why movements in Japan's bond market are now watched closely by investors around the world, not just for what they say about Japan, but for what they signal about global liquidity and borrowing costs. Risk assets feel this shift faster than almost anything else. Crypto markets and the yen carry unwind. The crypto market has also felt the effects. Bitcoin and other digital assets have historically benefited from periods of abundant liquidity and low borrowing costs. But as liquidity tightens and the yen carry trade unwinds, risk assets like Bitcoin have seen increased volatility. Some analysts even argue that Japan's bond market shift was one of the drivers behind recent sharp movements in Bitcoin's price, as global capital flows rebalanced and risk appetite shifted. In this sense, Japan's decision isn't just a macroeconomic policy shift, it's a direct influence on markets that traders and investors around the world follow closely. Effects on gold and commodities. Gold and other commodities react differently but still noticeably. Gold often serves as a safe haven when markets are turbulent or when inflation concerns rise. However, higher interest rates increase the opportunity cost of holding non-yielding assets like gold, which can dampen its appeal. At the same time, higher yields in Japan and elsewhere push investors toward yield-bearing instruments. Commodities more broadly can be influenced by shifts in global liquidity. When the carry trade unwinds and capital flows tighten, demand expectations for energy and materials can adjust, influencing prices across sectors tied to global economic growth. Everyday implications for American households. A Japanese policy change may seem esoteric, but it has real implications for ordinary people, especially in the United States. Mortgage rates and loan costs can rise when U.S. bond yields climb following shifts in global yield curves. Retirement accounts and portfolios can experience increased volatility as asset prices adjust to changing liquidity conditions. Savings rates and returns can improve when interest rates rise globally, but that benefit comes with higher borrowing costs too. This is why financial advisors are paying attention to global central bank dynamics, because local economic conditions are now deeply interlinked with international policy decisions. Moreover, the current global environment shows that the era of cheap money may be ending, not just in Japan, but broadly. Almost all major central banks have shifted away from years of rate hikes and are signaling new regimes for rates and liquidity, which could mean more volatile markets ahead. A historic turning point. Japan's decision to tighten after decades of near-zero rates marks a historic turning point in global monetary policy. For many years, Japan's monetary stance provided a foundation of cheap liquidity that fueled asset markets worldwide. Now that foundation is shifting, traders are unwinding carry positions, and markets are rebalancing in real time. This moment is significant not simply because it affects Japan, but because it reflects a broader shift in how central banks around the world are approaching monetary policy after a long era of exceptionally low rates and abundant liquidity. This shift is still unfolding, and markets may not have fully priced it in yet. Final thought. Whether you're an investor, a saver, or someone planning for your financial future, the effects of Japan's rate changes are worth understanding. What started as a distant policy decision in Tokyo has become a force reshaping markets from Wall Street to Main Street, and the repercussions are still unfolding. The global financial system is dynamic, complex, and deeply interconnected. Japan's recent shift reminds us that changes in one part of the world can have far-reaching consequences elsewhere. That's the reality of finance in a globalized era and why history and money must be understood together.